commentary for April the 6th of 26. So the reason I'm teaching today is somebody requested that they want to know a little bit more about this kind of stuff on volatility, and I get excited about this stuff. So Kevin reached out and told me, I think you want to teach this, so I do. And what I want to talk about is the difference between implied volatility and realized volatility. There was an article, let me go down, I put it up here on this document so that you guys can look at it later. Investing.com had this article, Is the VIX Lying? And it went into the differences between historical volatility and implied volatility. And it showed that there's this big gap between what the market's expecting, and that's implied volatility, versus the actual stock price movement, and that's the realized volatility. And so they have this little graph that they keep track of the difference, and they said this got up to a 2 standard deviation difference, and it was pretty cool and stuff. And I sent that article to Kevin, I think it was last week, when I saw it, and I'm like, this is what I'm talking about. And we have so I with Don Fishback, Don developed a tool that it gives a better illustration, I believe, in those differences. And that's what this graph is right here. This is micron, and what this green line is. So when you think about implied volatility, it can get really complex if you want it to be, and it doesn't have to be. It doesn't have to be that difficult. The developing the Black-Scholes option pricing model helped Fisher Black and Myron Scholes and those guys, the ones that were living at the time anyway. It helped them win the Nobel Prize for bringing order to the options markets. And there's a basic assumption that model makes, and it is this green line right here. It says the future movement of the stock price over any period of time is going to fall into a log normal bell curve. And I'm sure you guys have forgotten all your college math and all that kind of stuff. You don't need to remember what logarithms are and what bell curves are. All you need to know is that this is, in many situations, this is a reasonable assumption. In the stock market, it's just not. So anytime in real world, anything that you model and create a model for, it's almost always guaranteed to be wrong for every individual asset. It's only when you combine all these different assets and put them together that it kind of fits. And so what Don Fishback did is he put this little graph together where it shows the market's expectation right here, and that's the green line, which is the log normal bell curve. And then he shows this other histogram back here, which is the realized, it represents the realized volatility. So this represents the current option pricing and what the market is expecting, the green line, and the blue histogram in the back is telling us what the actual distribution of the stock has been in the past for the and this looks back, going back 4 years is what I use typically. So my statistics professor beat into me that you have to have at least 1,000 data points to have reasonable statistical information. And he beat that into me, and guess what? Over a 4-year time period, there's 1,008 trading days, so we have 1,008 data points to observe. And you can see here that they look different, right? The actual stock price movement is not matching the estimated value here. So what this particular graph is telling us is that if there's a move that goes up 53%, the chances of that move, and this all reverts back to probability, the chances of this move, based on what the market's expecting, is this green line. They're expecting a 53% move to happen, far more, almost twice probably a little bit more than twice as often as the stock has actually made a move up that big. So this is telling us that the market is overpricing options. So we can see this great big stack here in the middle where the stock price has actually stayed range bound in this area. And if you remember from statistics class, 2/3 of all outcomes lie between plus and minus 1 standard deviation. Well, there's more than 2/3 of those prices staying in plus and minus 1 standard deviation if you're following the model. If you're looking back at the actual prices, it stays put a lot more often than that. So this graph is telling me, when I look at this graph really quickly, I can say I know right away that these options are extremely overpriced. Don went a bit further, and he has this little table down here. And now this data is as of Friday's close because it's an end of day data. So it's as of Friday's close, or not Friday's, but Thursday's, sorry, Thursday's close because last Good Friday the market was closed. But as of Thursday's close, the asking price for a call, an at the money call, was $33.40. What should the price of the option have been if the market was expecting the stock to continue to behave the same way that it did over the past 4 years? Well, the price should have been 23. So that's $10, almost $10 overvalued on that option. So we don't want to buy options that are $10 overvalued, right? And that's one of the reasons why we use our strategies that we use. We've got to figure out how to not pay ridiculous prices for options. And one of the ways to do that is to sell another option and let some other dummy pay for it, right? And so that's why we use our collar strategy to do that. You can see here that the put is 36 versus 27, about the same, about almost $10 overpriced. And you have to look at every time frame, so each individual option that you look at, you have to look at it and analyze it and evaluate how it stacks up over the history of the moves and whether it's fairly priced or not. Because there's a whole bunch of factors that affect option prices. One of them is the current stock price. My current stock price is pretty pricey, right? 370 about on Thursday of last week. Now let me show you a different one, Meta, and I'm just using stocks that we have in our holdings that a lot of you probably have in your accounts. So you can see this one looks a little bit different. In this case, it's the green bell curve that is really tall, and it's the blue histogram in the back that's kind of short. But when you get out here to these outline moves, what this is telling us, if the stock goes down 33%, almost twice as frequently as the market expects it to right now. And that's based on the prices, the most recent option prices we threw into this. So when we look at the values down here again, you can see now these aren't, and you've got to always remember when you're looking at option prices, price is relative. These stock prices and on these technology stocks are pretty high, right? And the stocks are volatile, and we've got this war going on and other events and things like that. So we've got a lot going on, but even with all that stuff going on, Meta is, they're not pricing these options accurately based on the way the stock has moved in the past, which is pretty, that's a good thing for option buyers. We want to get this kind of a deal. When we buy an option here, a call option would have cost on Thursday at the close about $34.25. The value, what price that option should be when we were placing that, if we were to place that trade, it should have been $42.97. So that's almost $7 over or underpriced. So whenever something is underpriced and you're buying it, that's an advantage that we get, right? If options were priced at this fair value right here, this is the fair value if the stock was behaving the way that it did over the past 4 years. And we're not interested in fair games. I'm not. I'm the oldest kid in my family. I always win. I used to sell my brother's, beat up dollar bills, or something like that for new coins. Whenever I was doing whatever I was doing, I was always making it so it's always in my favor. And guess what? I can do the same thing in the market. So we we want to make sure that we're always the one getting the deal whenever we're doing these trades. And now in this case, we could just buy straight calls, and we'd have a $7 advantage. Sometimes we want a bigger advantage because the market's uncertain. So there's other factors in our decision-making process besides just looking at the graphs and deciding whether the options are cheap or expensive. But deciding whether the options are cheap or expensive is one of the most important things that we can do as advisors for you guys. We just cannot afford to pay too much for these options, because if you pay too much, your chances of winning on that transaction are actually go down. So it pushes your break-even points further and further out. So those are two examples of the graphs that we're looking at on holdings that we have in our account. I went through and just grabbed a whole bunch, and you can see these options here are fairly priced on Disney. They're pretty fairly priced. These options are slightly underpriced on Ford. These options are expensive on Walmart. These are really cheap options on Palantir. And that's a good one, because that thing can move just as big as some of the big ones we have in our account when it decides to go. So I really like that we have that holding in our accounts, in some of your accounts anyway. Some of these you can't. Some of these, these are just some of the holdings that we have that I've been going through and analyzing. And you can just look at these. They're mostly, if you look at them, only a few of them are actually cheap. Most of them are either pretty fairly priced or they're overpriced. And that's just the situation that we're in right now. The market is being sentiment driven. Uncertainty is ridiculously high. You've probably heard of the VIX being called the fear index. And it's a really convenient way of looking at the market. So the VIX is the volatility index of the S&P 500. And when people look at that and they're seeing a disparity, and that's what that article is talking about. If you go and read this article, is there's a disparity between the realized movement of the assets or the index and the fear that's going on, or the level of uncertainty. So when you look at VIX and you see it spiking, it's a good thing to say, hey, uncertainty is rising. There's a lot of uncertainty in the market. Then you try to identify what's causing the uncertainty. In this case, we know it's the war, and it's President Trump's back and forth on different things and whether he can be believed or not on what he says. The taco trade kind of stuff. We'll see. His comments today was a lot of the same rhetoric, and he, and there's a deadline tomorrow. We'll see what happens. We don't know which direction the market's going to go. And that brings up another thing. So which way, when we see a big diversity in, or big difference between the expectations and the realized volatility, at some point that has to resolve. The theory is that volatility always returns to the mean. And so in this case, every time you place a trade, you've got to think about this. Is the market going to tame their expectations and have them come back to the realized volatility, or is realized volatility going to increase and go up? And that's where the uncertainty lies. And that's so when uncertainty is really big, nobody knows which way it's going to go. You can make a case for either one, but it's got to resolve at some point because volatility always returns to the mean. And so we'll see how things play out over the next few days here with war stuff and what happens tomorrow after the deadline passes. Some other things I wanted to talk to you guys about. I'm really, really happy with the stocks that we're in. And you've probably heard Kevin say this a bazillion times. I'm just going to say it again. So we want to be in the stocks that are carrying the index. You've probably heard this, 4% of the stocks over the last 100 years account for 100% of the market gains. So we want to be in those stocks that are carrying the index. And guess what that is? Right here, this first graph is just showing you that technology has the biggest market caps, right? The biggest market weighting. 28% of the S&P 500 is technology stocks. And that's what we're in heaviest, right? That's where we're in the heaviest, is those technology stocks, and that's what's carrying the market. This little graph right here, I could probably blow this up a little bit. Anyway, it's showing you the change this last week, and where. So some of you might be saying, "Oh, we should be getting into oil. We should be doing this and stuff." But if you look down at materials, that's been one of the worst performers right there, materials. But if energy sectors down pretty low too. Here, these are the spider sector funds that I'm looking at, just listing here. But the one that has the best change here recently is those technology stocks. Those are the ones that we're in. That's what we want to still be in that. So I'm really happy with the choices that we've made there. And I do want to also bring up that if you ever disagree with some of the choices that we're making on what we should be in, these are all your accounts. And something that we do that's different than other people is we invite you to have a say on what we're doing in your account. So if there's a stock that you don't like, let us know. I've had, this was a long time ago, and it wasn't because I was trading for anybody, but I wrote a newsletter and I was telling them to invest, I think it was Playboy or something like that. I can't remember. Anyway, they had a moral objection to trading that particular asset, and I have moral conditions sometimes on the assets that I trade. They're stocks that I just don't want to play with at all. But it's just because I have a moral objection to what the company does. It doesn't necessarily mean that I can't make money off of the company if the situation is right. So we do what we think is best for your account based on just the numbers, right? Kevin's always talking about just look at the numbers, look at the fundamentals of the company, look at different things, and that's what we do. And look at technical information, technical analysis, and do that. If you have a moral objection to getting into any particular asset or anything like that, pick up the phone and call us. We'll pull it out. We'll follow your wishes to some extent in there as well. We'll try to get you out the best way possible so you don't potentially lose money. We're happy to have you talk to us and tell us what you're looking for and what you want. So nothing's really changed from briefing last week to this week. Fog of war still clouding the prior rose-colored outlook. And like I said, that deadline is approaching tomorrow night at 8 p.m. and we'll see how everybody reacts to that. But we're just trying to get past this, to have the market choose the direction up or down. We really don't care. We've got a lot of protection on a lot of the positions that we have. This last week was really kind of, we had some heated discussions about what we were, what we should be in, what we shouldn't be in, when to take things off and when not to. And it's really difficult in a kind of sideways market, but the market's been rebounding a little bit. You can see most of these big indexes. Here's the Dow Jones Industrial Average has been down, 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 down. And then it started popping back up. Well, do we take protection off? Not necessarily. In this, normally yes. Normally we would take those puts off, pull out whatever money we could get out of it. If we were profitable, we would pull it all off and go. So in this last week, we might roll down. We might sell some other assets if options are expensive to keep some protection on. There's a whole bunch of different things we can do. But if you just look at the past couple of weeks, it's been pretty choppy back and forth. And so with all the uncertainty in the market, we still want to keep some protection on, because we don't know how things are going to go in this war. I don't think anybody does. I don't even think Trump does. Let me get that down. And similar pattern here in SPX. It's been bouncing back up. And do we take protection off? Still the same answer. Normally we probably would, but under these conditions, probably not. Some of the assets and that's another thing that we do is some of these assets we've got coming up are going to have earnings pretty soon, and we've got protection on going into earnings. So some of those things we just left alone. We didn't even touch them. We're still kind of bearish, but we still think the market's going to be up substantially by the end of the year, and that it's going to continue to do better. So we're overall positioned for long-term growth. But if it does roll over and heads to the downside, we will we'll probably we'll double up on puts that we own, double up on protection so we can make money going to the downside. That's just been really hard to do with options being as expensive as they are and the market being as uncertain as it is. Economic reports coming out this week. We've got FOMC minutes coming out on Wednesday. That could cause a little bit of a stir. We'll see how many Fed governors, voting members are saying that they think we should raise rates versus lower rates versus continue to hold. I don't think anybody's changing anything in the near future. I don't know that anything will change until Powell is removed and a new FOMC chair is put in, and then we'll see. I still don't know if they're going to have a lot. It's just the data part is just really, they're supposed to be following data but they kind of don't, and so it's kind of rough. Other information that we have coming out. So PCE is that personal consumption expenditures. That's what the Fed looks at in making decisions on taming inflation and meeting their mandates for job security and price stability. That's what they're looking at. So if we get a surprise there, we could potentially see at the next Fed meeting some kind of a move. I'm not 100% sure which way that's going to go. CPI is coming out on Friday. That's another thing that they do look at, and we'll get all those numbers. So those Wednesday, Thursday, and Friday could all be big things. Tomorrow we've got probably there's durable goods and some consumer credit. There's some information that's coming out, but I don't think it'll likely affect the market as much as whatever happens with the Iran deadline in the evening. So my guess is tomorrow will be kind of a holding pattern until we see what happens. But then on Wednesday when we get those minutes, and then Thursday when we get PCE and CPI, if there's any surprises in that data, that could be something that will have the market go crazy. So we'll find out. Next article I wanted to talk about was Powell sees inflation outlook in check. So it's funny because as I look down through this, everything he was talking about in regard to inflation and fuel prices causing inflation, he was very careful not to say the word transitory. But basically that's what he's saying. If you read the article and everything in here, he's just not saying that one word because he took so much flack from the last time he said it. And they kind of missed the boat. So that's the other article. You can read it here. It's good information to have. But any questions from anyone? I kind of threw a lot of information at you pretty quickly. A few of you have heard about these graphs before, but I thought a lot of you would be pretty new. All right, no questions. So whenever I don't get any questions, I just assume that you guys understood everything that I said. And so if you think of questions later, if you're reviewing it later and the questions pop up, then just let us know. Send us an email or a text message, whatever, and I'll be happy to answer to the best of my ability. All right. I was trying to keep it to a half hour. I think we did pretty good. So I hope you guys have had a wonderful Easter weekend, and I hope you have a good week this week. I hope everything goes well. We'll see how the market shifts going forward here with I'm hoping we get a little bit more certainty after this deadline passes tomorrow and what our actions are going to be, and where it's going to take the market. So we'll see what happens, but there's just so much going on. So we'll just keep watching. We are watching your accounts every day, and if you have any questions, you can always reach out and talk to us. So alrighty, I hope you have a wonderful evening and a wonderful week, and we'll see you next time. Bye-bye.